Hey, it's Jim, and this is level 3 of the CFA program, the Private Wealth Pathway, and the learning module on investment planning. The title of this learning module really could be, you know most of this stuff. What the Institute is trying to do is take the breadth of the policy statement and add a couple of layers. So there are some new concepts in here, but most of the breadth and a lot of the depth is going to be familiar. You know, the first couple of paragraphs mention Harry Markowitz, tax efficiency. There's a conversation on the Sharpe ratio. There's all sorts of fun stuff in here that we've done before. But the idea is that the Institute is trying to put this into a more efficient kind of a presentation. I'll let you decide if you think it's more efficient than what you've seen in the past. I will say this. The Institute, at least in my estimation, went to these learning modules to kind of compartmentalize them. But I'm guessing you've noticed that these learning modules, they're not 7 or 12 pages long. So they seem to be getting longer and longer as we get deeper and deeper into level 3. So just 4 LOSs for this very long learning module. And these are just really general ones. Notice we want to discuss and evaluate. But you might remember in one of the previous recent learning modules, we talked about the importance of asset allocation and that action word justify, and here we have in this first one, recommend. So we're going to do some portfolio allocations, and then we're going to either justify them or recommend them, and we need to do that in the context of tax management, jurisdictions, and as all part of some, gigantic, let's call it an aggregate investment program. So let's get started with exactly what you know from previous conversations. Yes, investment planning involves lots and lots of stuff, but I'm guessing we can narrow it down to just 3 here. So setting financial goals. And by the way, this piggybacks exactly off of what we did in a previous learning module where we had those goals-based strategy where we're saying things like, we got some short-term stuff, we have some intermediate-term stuff, and we have some long-term stuff. So setting those financial goals and then developing a strategy. So we have this umbrella strategy for the aggregate portfolio, and then we have kind of, can I call them sub-strategies for the sub-portfolios? I always, the Institute uses the term sub-portfolio. I like to think of it as different kinds of silos. And then we need to figure out willingness to take risk and ability to take risk. And so once we figure out those 3 bullet points, then we go over to the little box over there and we say, hey, here's some possibilities for asset allocation. Here we've got 20 and 50 and 30%. Of course, those sum to 100%. Now, what the Institute is very big on now in this year's presentation is the combination and almost the importance. Is that a word? How about equally important of both public markets and private markets? I mean, back when I was going through this several decades ago, I don't even remember if we had a conversation on private equity or private debt. We probably did a little bit of stuff, but I'm guessing there were no questions on my exam. And if there were, I probably got them wrong. The emphasis has traditionally been on, the public markets, but now these private markets are taking an equal role in this asset allocation model. Risk tolerance. So what does this mean? Ability to take risk, which is usually a function of things like wealth and age and income, and then willingness to take risk is a function of things like personal preferences. So of course a wealth manager has to evaluate the risk tolerance. It's probably done through some interviews and a questionnaire. I used to tell my students, I don't do this too much anymore, but I used to tell my students that the great question to ask a client is that if you were walking along the boardwalk by some ocean and some dude was there and he said, hey, for $20, I'm going to allow you to sit in this seat and I'm going to pull you way back and I'm going to slingshot you out over the ocean. If you were to say your answer to that question, would you do this, or how likely are you willing to do this, is really pretty much all you need to evaluate a client's risk tolerance. I mean, me, as a 62-year-old, there's no possible way I would have done it. Even as a 20-year-old, I probably wouldn't have done it. But there are lots of people who, love those thrill-seeking things. So what the Institute has done is it's gone to a little bit of a less crazy kind of a scenario than I just presented you. So here, to try to figure out risk tolerance. So think about this. How much does your friends and families influence a financial decision? My wife and I, we talk about this all the time. Do we want to do this? Do we want to do that? We're very co-influential for our financial decisions. How about financial experiences? So these investment mistakes and financial experiences, this has almost everything to do with our conversation on behavioral economics and behavioral finance. Do we suffer from confirmation bias? Is there the disposition effect in play? Do we have herd mentality? Are we anchoring? All those kinds of things, they're going to influence. And remember, a part of our job as a good wealth manager is to educate and advise. So we could try to say something like, you might be guilty of anchoring, but let's try to figure out a way so that we can de-anchor, so that we can form an efficient portfolio. I'll go back to what the Institute refers to in maybe it's the second or third paragraph when it uses Harry Markowitz as an example. We're trying to form an efficient portfolio. And so we're trying to eliminate all of those obstacles that prevent us from getting to an efficient portfolio. And then look at that bottom one, the client's perception of investment risk. I think this is a really good exam question because it's really easy for the Institute in a question. Think about a case study or a vignette where it just slips it right in, blah, 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 blah. And then all of a sudden there'll be, maybe just 7 words where the client hates mortgage debt or credit card debt or just something like that. And then they'll ask a question at the very end and you're thinking, oh my gosh, I'm not quite sure I read that. So it's very easy to throw a line in there. So make sure, I say this to you regularly, make sure you're reading along the lines and absorbing every sentence and every word inside of that case. Now, let me go back to that previous slide here. I think I wanted to make sure I said this orange point down at the bottom, the wealth manager's own view. Of course, I've seen this sitting, in trustee meetings where board members will say, well, you know what, I have this attitude towards risk and try to be influential to others inside of the room. I don't know how good of an exam question that could be, but that's probably a potential one there. Yeah, multiple goals. This is what I was saying. They don't have to be short, intermediate, and long term. You can have multiple goals inside of each of those kinds of silos. So you're probably going to have different levels of risk tolerance. We talked about that at length in a previous recording. Look at the bottom there. Break up the portfolio into a collection, a sub-portfolio. Yeah, so think about, let's do intermediate terms. So what do we want to do in the intermediate? Suppose we have a client that wants to buy a vacation home and pay for a child's wedding and travel. So we have these 3 kinds of goals. The easiest thing to do is just to ask the client to prioritize these, and then assign, some kind of a number or a letter. If we couldn't do this, how upset would you be? I'm guessing that if you're paying for your son or daughter's wedding and you couldn't do that, that's probably a higher priority than traveling or a vacation home. So the whole ranking system, and this appears throughout the CFA program, not so much in level 2, but back in level 1 and now in level 3, a little bit of that ranking. So I think that's a good way to attack this kind of a question with the multiple goals. All right, the next section asks the question that sounds something like, all right, we know we have to allocate. We know we have to allocate between and among fixed income, equity, and alternative investments. How can we do that? do we want to just do some passive investing? Do we want to find some indexes that are perfect for us? Or do we want a tailored or a customized portfolio within each of those asset classes? So this particular part of the learning module focuses on the indexes and what it means to look like a passive investor. So we're looking here at the return on a fixed income index. And so you can do this a couple of different ways. Notice up at the top, there's this concept of the initial yield, which, you can compute that relatively easily. But then note there's constant duration and modified duration. So remember maybe you don't have to compute duration here in this LOS, probably not. But remember how you have that first duration, the Macaulay duration. Then you can modify it. Remember, you modify it just by dividing by 1 plus the yield to maturity. And that gives you a good measure of, the sensitivity of the bond price to changes in yield. But in conjunction with what we were talking about here, let me just go back here to emphasize. So look at the blue at the top. Multiple goals and objectives. So if we have a short-term objective and we're going to use some fixed income securities to meet that objective, and by the way, remember, if you're writing this out, use the term immunization. Or if we have a short term that's 2 years, let's say it's 2 years out there, we want to buy a bond that doesn't mature in 2 years, unless it's a zero coupon bond, or we want a bond that's maybe a 3.5-year bond that has a 2-year duration. So remember that asset liability management kind of a conversation and the immunization. So what can we use to determine the expected return on this fixed income index? We'll just use the current yield to maturity to estimate those expected returns. So you think about it, you have an index of maybe 20 different bonds, and so you can compute the weighted average yield to maturity. I can't imagine that you would have to do that in any CFA question. But don't forget to add some measure of inflation in there. So what we're saying, and I want to go ahead, I think this is important here, even though this is not part of the LOS. Remember back in level 1, we did that building blocks model where we had the real risk-free rate of interest, and we added stuff to it, like the inflation premium, like the maturity premium, like the default risk premium. So for this short term, think about that. Now maybe liquidity premium is zero. Maybe, the inflation premium is not going to be zero, but the maturity premium, they all might be zero, which is essentially what the Institute is saying here. But I think if you think of the short-term portfolio, that silo, in terms of the building blocks model, I think you'll be able to answer all of those questions. Now, for longer term and for the higher yielding indexes, of course, so these higher yieldings would tend to be longer term, and they would tend to have less than investment grade. We're going to go ahead and use what we did in previous learning outcomes of the probability of default and that loss given default. So how are we going to do this? This is relatively simple. So all we're going to do is we're going to take the yield to maturity on the index, and we're going to subtract the product of the default rate times the loss given default. Let me go ahead and give you a quick example here. Let's do one bond first. Suppose we have one bond that has a yield to maturity of 10%, and it sells for its par value. So look up in that blue equation there. Yield to maturity on just one bond is 10%. And let's subtract this out. So let's think about it. Let's suppose this company is Jim's Concrete Company. And so if Jim's Concrete Company defaults on this bond, let's suppose that I have a bunch of trucks, right? Cement trucks and concrete trucks, and I probably have a quarry. I have a bunch of rocks and sand. If I default, you as a bondholder can sell all of my assets. Suppose you get back $700 out of that $1,000. Suppose my default rate is just, let's say it's 10% to do the math. So we take that 10% inside of the parentheses, multiply that by the loss given default, which is only 30%, right? So 10% of 30% is 3%. So that expected return would be, well, what did I say? 10 minus 3 is 7%. So you'd have that for my one bond. And if you have, let's say 20 bonds in an index, you just do a weighted average. I mean, if they all were selling for $1,000 at par value, well, then you just add them up and divide by, what did I say, 20 or 30, whatever that number was. But if you didn't, you'd have to do a weighted average based on the ratio of individual bond price versus the entire bond portfolio or the index. I'm not sure you need to do all that math for this question, but what I want to do is emphasize the simple fact that LOS, those action words to recommend and justify. It's easy if you're writing this out to justify the selection of an index if you can just prove what that expected return is to match the return objective of that particular client. Now, how about the return on an equity index? I always have my students, when they do this for my investments class, I have them go to Barron's. Every 6 months, Barron's interviews about, I don't know what it is, 25 or 30 different analysts out there, and they say, hey, what do you think the S&P index is going to be in 6 months? And they get 20 or 30 of these things, and they take an average. And so that's the expected return, and that's what I have my students do. Now, the Institute's not going to have you do that. At least I don't think they would, because they mentioned the Myron-Gordon growth model. So all we're going to do is take that dividend yield and then add some kind of let's generally call it a capital gain or the growth rate in dividends. I remember one of my professors in college said that that's an estimate of capital gains. Growth rate in dividends is not a perfect estimate, but take the dividend yield, make sure you do the forward dividend yield. Boy, the Institute could give you, hey, here's the historical dividend yield, here's the current dividend yield, but this is what we think is going to happen in the future. Make sure you pick the forward one. A couple of other ways to do this. You could easily use this cyclically adjusted price earnings ratio. That's just the current price of the equity over some years average of real earnings, and the Institute uses 10 years, so probably 10. I can't imagine they would give you 10 and 5 and 20 and have you pick those, so just remember 10. Or you can use the rearranged version of the Myron-Gordon growth model, which is, this is pretty much what the orange is right down there, and that'll give you an estimate of the expected return. Now, what about other asset classes like alternative investments? Well, what are you going to do here? I could go back here. We have lots and lots of data for fixed income. We have lots and lots of data for equity. We don't have much data for the alternative investment universe, but we do have some historical estimates. So we can start there. Notice we've written due to limited data, right? So that's important. So start with a historical estimate, and then, well, I'm going to use this term again. Let's just add a building blocks model to it. It won't be the building blocks model that I just referred to a few moments ago. It'll be kind of our building blocks model for whatever alternative investment or whatever this other asset class is, based on whatever kind of risk is relative and relevant for that asset class. Of course, one of those premiums has to be some kind of a premium for giving up liquidity. I mean, that makes perfect sense. And then somehow you need to throw a growth rate in there. So if you remember those three little gray boxes down there, I think you'll be able to come up with that. Come up with a good answer for an expected return on other asset classes. Oops, I didn't want to go that way. I wanted to come back here. So think about this. You have lots of bond information. You have lots of stock information. And you have limited information and data and the alternative investments, so you kind of have to make up for it. Yeah, we know all this back from level 1, right? What are the risk of asset classes? So we're going to talk about standard deviation, which is the square root of the variance, and we can't forget covariance. I have my students do 3 years of monthly returns just because it makes the Excel spreadsheet a little bit less unwieldy, but the Institute mentions using 5 years of monthly returns. What you can do then is put them together into a covariance matrix, and then you can do a whole bunch of stuff with that. But the cool thing about that covariance matrix is that you can actually see exactly what that relationship is between and among. So think of Harry Markowitz and the Efficient Frontier. What happens as we add stocks and add bonds and add alternative investments to the portfolio, we have more and more securities in there. So the importance of each individual security lessens as the number of securities in the portfolio increases. So what that means then is that standard deviation becomes less and less important, and beta becomes more and more important. Now, illiquid assets, we know this, right? Not mark to market regularly. I didn't use that term a minute ago, but that's a good summary. If we're going to estimate the variance by doing things like just estimating what the value is. A year or so ago, I had a student as part of the alternative investments policy statement. He picked a $300,000 or $400,000 rare bottle of whiskey to invest in for his client, which was really a cool thing. And, I mentioned to him, I said, how are you going to figure out the standard deviation? And he goes, well, it has sold a couple of times over the last 2 or 3 years. And I was like, all right, so you have 2 or 3 or 4 data points, but what about like a daily standard deviation or a monthly standard deviation? And he goes, well, why don't I just put that into an Excel spreadsheet, and then I just take some averages in between and I move it up and down and up and down. I'm like, dude, that's something that people do. That's called smoothing, or coming up with some type of a value that has no reflection of reality, but doesn't really tell us about risk. So that's the good question there. They're going to underestimate their true standard deviation, because when you do that smoothing, you're not going to get all the peaks and the valleys. You're just going to, you're going to smooth it. Sometimes I say things that are really, really profound, and then I say things that are silly like I just did. All right, so how are we going to estimate risk? We want to do basic and essential characteristics such as growth rates. We want to add and subtract risk differentials. Be careful if you subtract. I imagine the Institute might ask you to subtract something, but make certain that you're convinced that you should actually subtract. When in doubt, don't subtract. Now, you can use value at risk, which we've talked about at length. You can use expected shortfalls, which we've talked about at length previously, not in this recording. And then stress tests, which we've talked about at length as well. I will make a kind of a current events comment. I keep telling you guys to read the Wall Street Journal all the time. I just read the headline just the other day. I didn't read the article, but the headline read, U.S. banks pass their most recent stress test. So I guess that was a good thing for the U.S. economy and U.S. financial institutions. But essentially, those stress tests say something like, what if the worst thing that you could possibly think of happens? What's your fixed income portfolio going to look like? So look at the orange there, a range of unfavorable scenarios. Think about it. Go back 5 or 6 years or however long ago it was. Who put COVID into a stress test? I don't know. I hope somebody did. I hope there's somebody smart out there that said, you know what? I don't know what it's called, but suppose that we have this outbreak. How many in 2006 put in the 2008 financial crisis for that stress test? Well, some people did, but probably not enough. How many in 1987 in their stress tests put in the 1987 stock market crash? Well, I'll probably say nobody, because even back then, I can't remember when we started doing value at risk, but I think it was after 1987. So let's go ahead, figure out these unfavorable scenarios, and then, let's have a baseline. What happens? What breaks down? This is why we do things like key rate duration. What breaks down? Is it over here? Is it over here? Is it over here? That's why it's so critical to have short-term, intermediate, long-term goals, because a stress scenario might have no impact in the short term, but it might have a substantial impact on the long term, which then gets us right back to that LOS. Recommend and justify. So you need to kind of marry all of these things that we're talking about. Look at that third rectangle there. Make suitable adjustments to the portfolio. So I can't guarantee you. I always like to say that. I can't guarantee what the CFA Institute is going to do. But I'm fairly confident that I can fairly guarantee you that you're going to have a client in a case and something's going to happen and they're going to say something like, recommend an adjustment to the portfolio without compromising return. That's a really, really great question. All right, let's do something that looks a little bit like math. So I've said to you that Harry Markowitz was mentioned a couple of times. So there's this mean variance optimization formulation. So what are we trying to do? We're trying to maximize the distance between. All right, think about the Harry Markowitz efficient frontier. What do we want lots of? We want lots of verticality, right? We want on the vertical axis, we want lots of expected return. What don't we want? We don't want lots and lots of standard deviation. So we don't like the horizontal axis. So what do we want to do? We want to get close this way and up that way. So that northwest corner up there is kind of the goal. Of course, what do we call that? We call that the unattainable region. So the way we do this in calculus is that we say, all right, let's maximize the distance between the expected return and the consequence of earning an expected return, which is risk. And so we'll just call that portfolio variance. Remember, that's sigma squared. And what we're going to do is we're going to adjust it by some factor. And we're going to have that gamma in the numerator, which is a measure of the client's coefficient of risk aversion. Some clients hate risk. Some clients are going to love risk. And that gamma in the numerator is going to be reflective of it. Now, the 2 in the denominator is not just we're taking 1/2 of this, but those of you who know something about calculus know that the variance is a squared term, and so you can, instead of drawing the big square root sign, you can put it in parentheses and raise it to the 1/2. So when you take the first derivative in respect to the weights, that 1/2 comes all the way down to the bottom, and there you get 1/2. Now, the Institute in this learning module doesn't explain this to you in any way as it relates to calculus. There's just a sentence in there that says, don't worry about it, it's just a constant, it's just going to be like that. But for those of you who care about math, it's the result of taking a first derivative. Let's go back to the max sub W there. So what Harry Markowitz does is he says, okay, we have an expected return, we have a measure of risk, let's call it variance, and we have the client's coefficient of risk aversion, which might be a 1, it might be 2, it might be 5. And so each maximize according to the weights for that particular client will produce the highest return at each given level of risk. Now, a couple of things that the Institute tells us, that gamma falls between 1 and 10. I don't really have too much of a comment on that, but I will say this. Let me go back here real quickly. Let's just suppose that gamma is 2. Suppose the expected return on the portfolio is 10. So we go 10 minus 2 over 2 is 1, right? So that gets rid of that thing. And so let's suppose the variance is, a couple of percent, whatever that is, say 2%. What does that turn out to be? Can I do the math real quickly? Is that about 14% standard deviation? So 2%, so you take the 10 minus the 2, and that gives us 8. And so what Harry Markowitz is going to do is find the weights in our asset classes, the fixed income, the equity, and the alternative investments. Harry Markowitz is going to find the weights that maximizes that distance. So what did I say? We get up to, 8%. Harry Markowitz is going to push this way and push that way to get us that efficient frontier and that efficient portfolio. I think the Institute makes a comment in the learning module that gammas typically are somewhere around 2 or between 2 and 3 or somewhere in there. But I'm guessing the good exam questions are what we have up at top. The client values high returns more than low variance. And if gamma is large, the client values low variance more than high returns. I think if you remember that, you should be okay. Now, what don't we like about this mean variance? And I go through this with my students all the time because we use Solver in Excel, and we draw the efficient frontier. There's a little checkbox in Solver, maybe some of you know it, that allows for short positions. And I allow my students to do short positions. And I always say to them, just because you check that box, and that's what we're going to do, doesn't mean that if you wanted to put your portfolio together, that you could short Apple stock 72%. So remember, limitations on short selling, you might only be able to sell short, let's say 5% or 10% or something like that, which, of course, in Excel, you can put that in as one of the constraints. It's difficult, not impossible, but it's difficult to assign maximum and minimum exposures to asset classes and assets. You can do it, especially in the advanced software, but in the regular old traditional Harry Markowitz stuff, you can't do that. And then, of course, sectors and geographical areas, you can't do that at all. Then, of course, Harry Markowitz ignores turnover and trading constraints. I wonder if you guys remember a couple of learning modules ago, I mentioned the fact that it's very likely that the Institute is going to give you a balance sheet for your client. Well, this is kind of the section on here in this learning module that reminds us how important the balance sheets are in the context of not just asset liability management and modeling, which I referred to just a few moments ago, but also surplus management, which we talked, a pretty good amount in a recent recording. So assets typically include, well, you know what those assets include. Liabilities normally include, well, you know what liabilities normally include. And so what we're concerned about then is the difference between the two. We'll call that surplus, but don't be upset if the Institute in the case calls it a net worth or discretionary wealth. So the question then becomes, how do we manage that surplus? How do we invest that surplus? And it depends on lots of stuff that we've talked about in the last, what have we been doing this, 20 minutes or so? Now, this is important here. We need to worry about clients' future spending plans. So you're going to have to compute a present value of those future spending plans. I'm going to go ahead and say you're probably not going to have to calculate the present value of those future spending plans, but you're going to need to know how to calculate those future spending plans based on the inputs and getting back to the LOS, recommending and justifying. So what are some obstacles here? Yeah, who knows about healthcare plans? And determining an appropriate discount rate is difficult. The Institute suggests a treasury yield could be used, and I'm guessing that that's probably an okay interest rate. I would be comfortable using some kind of a building blocks model on there. Now, the next section is on taxes, and this LOS is on tax efficiency. So this is super important. We talked a little bit about this in a previous recording. If you look at the 4 cases at the end of this learning module, there's one on tax efficiency. I think there are 4 questions, and they're super, super easy. So what I'm going to try to do over the next few minutes is steer you to those super easy answers, but I'm also going to try, let's figure out what are more complex kinds of questions. All right, so types of taxes. We did this in a previous learning module. So taxes on income. Hopefully we don't have too many taxes on revenues, but some are out there. Taxes on wealth. Do you remember my comment? If we have tax on wealth, this is no fun. This is no good. This is not called free enterprise. But there, some politicians out there are trying to, at least in the United States, tax the wealth. And then taxes on consumption, taxes on gifts and inheritances and estates. Don't forget things like property taxes in there. Don't forget things like sales tax, which is probably included in the taxes on consumption. And so the idea is to, all right, we're aware, let me go back here real quickly. We're aware that, you can't do anything about the government, right? The government's going to be right there. And so you're going to have to pay these taxes. But what we want to do is we want to be aware of all of these tax obligations and then form a tax efficient portfolio. Notice the last part of this LOS, strategies for asset allocation. So that goes back to, here, let me go back and find, there it is. Recommend and justify. So we can do that for the first part of this learning module, but we also need to recommend and justify for tax efficient strategies for asset allocation as well. Different jurisdictions. I was thinking about this. There's not really a great question at the end of one of these learning modules. I'm guessing that the Institute, if it's interested in different jurisdictions, would have a sentence in there saying, oh, by the way, you have some assets that are located over here, and this tax place over here has the following characteristics. I mean, I think that's an obvious way. But I will say that, look at the very bottom one, tax deferred, tax advantage, onshore vehicles. This is one answer to one of the questions at the end of the learning module. Yeah, let's go ahead and do some math. All we're going to do is take a pre-tax expected return and multiply by 1 minus the tax rate. We've done that 1,000 times before, all the way back in level 1. Pre-tax standard deviation, we do the same thing. And for pre-tax variance, so we've got to square it, right? Because it's squared. So what are some interesting exam questions? Yes, an increase in the tax rate can induce more risk-taking by clients. This is a great sentence. This is a great thing to look for on the exam as part of, well, let me go back here, as part of recommending and justifying. So all of a sudden, if we have an increase in the tax rate, it might be that the clients are more willing to take risk. So make sure you have that link. Yeah, turnover management, what does this mean? We don't want to, I take my students to the Morningstar. We have the Morningstar software installed in our computers in the lab, and I take them to Morningstar. So we'll go to a mutual fund, and we'll talk about the whole mutual fund. But I point out the turnover, and I say, all right, we talk about turnover, and I say, is this a good thing or a bad thing? And I'll have students say things like, you know what, if there's lots of turnover, that means that the fund manager is really smart, and he's selling bad stocks and buying better stocks. I'm like, wait a minute. That's one thought, but let's look at the turnover ratio in the following way. A turnover ratio of 100 or 100% means that if the fund had 30 stocks to begin the year, and at the end of the year it had 30 stocks, but 100% turnover means that it had 30 different stocks. And so there's no possible way that starting with this 30 and ending up with this 30, that could be efficient from any standpoint, including a tax efficient standpoint. So notice the purple, investing in low turnover investment strategies, simple way to ensure tax efficiency. That's why I told you that story. Remember, you can offset capital gains by having capital losses. We don't ever want to have capital losses, but of course we're going to have them, and we can use those to offset capital gains. Index funds, yeah, they tend to be more tax efficient. I'm just going to go ahead and say yes, they are. And there's some legalities. Considerations for taxable investors. So think about our different silos, short-term, long-term, and intermediate-term silos for our objectives and our sub-portfolios. So we need to worry about the difference between short and long-term capital gains. We need to worry about what happens if we buy a bond that sells at a discount and that sells at a premium. Go back to your very first accounting class, whenever that was. We did a little bit of this, not a lot of it, in level 1, where we amortize the discount over the life of the bond, or we amortize the premium over the life of the bond, because what that means then is that you could actually not be receiving an interest payment, and you could still have a tax liability on that interest payment. And so it's a relatively simple concept, but remember, the Institute, they don't want us to be CPAs. So we don't need to know every rule out there about discounting and premium amortization for a bond, but we need to know somebody who knows those kinds of things. Yeah. All right, municipal bonds has preferential tax treatment. Municipal bonds here in the United States. So if you live in Alaska and you buy an Alaskan bond, that you don't have to report that income on your federal return, and you might not have to report it on your Alaskan state return. But if you're in Alaska and you buy an Arkansas bond, you don't have to report that on your federal return. But Alaska's going to say, why would you buy the Arkansas bond? Here we are. We have municipal bonds in Alaska. Why wouldn't you buy one of our bonds? So we're going to make you report that. Difference between qualified dividends and regular old ordinary dividends. And then derivatives. This is a fascinating concept. You know, back when I was in graduate school, our professors told us that if you were to trade futures contracts and you generated a capital gain, that it was up to you to self-report that capital gain. Back in the old days, there was like no way that the IRS could keep track of what was going on the New York Mercantile or the Chicago Mercantile Exchange. And I remember thinking, how can that be? But nowadays, of course, you have to pay taxes on all of those derivatives, and it's probably a capital gains tax. Yeah, currency gains and losses, you need to worry about what's the jurisdiction. Of course, you know, here in the United States, we have one set of rules for Canada, another set of rules for Japan, another set of rules for Iceland, another set of rules for Ireland. Remember that you don't need to know all those rules, but you need to know somebody who knows all those rules. Cryptocurrency, this is a fascinating area. If you read the Wall Street Journal every day, you'll leave your head scratching, like what is going on in this world. There's lots of good stuff about it, and there's lots of not so good stuff about it. But, you know, there has to be some type of taxation on the gains and losses. It's probably a capital gain. Real estate, make sure you know the difference between short and long-term gains. You know, the pass-throughs, whatever those kind of pass-throughs are, if that's simple like, you know, a mortgage-backed security or some other type of a vehicle out there. Make sure you know those differences there. Oh my gosh, I'm not even going to say those two words that are at the bottom. I always get chills up my spine when I'll go ahead and say it, double taxation of the corporate form. Wash sale, there's a good example at the end of this learning module where you had a client who sold a bunch of stuff, and then I believe it was 10 days later, they went and they bought it. What did I say? They sold a bunch of stuff, and then 10 days later, they went and bought something else. So that's within that 30 days here in the United States. So make sure you know wash sale rules. Bilateral tax treaties. That might mean that, you know, U.S. and Canada. If you do something in Canada, you don't have to pay taxes up there, but you might have to pay it here. So know about those treaties. And then the alternative minimum tax. Every year when I do on April 15th when I do my return, I'm always wondering, gosh, is that alternative minimum tax going to hit me? So far, it has not. All right, so what are we doing? We have these little silos. Now we want to call this the centralized portfolio management. Think of it as the umbrella team. Look at there up in the orange, a central single team designed to enhance efficiency, reduce costs, reduce taxes, ensure consistency. So what's in purple there, I think, is a really good exam question that sounds something like, hey, why are we doing this? And then any one of those answers are good. How about some tax implications for families? Yeah, this is really just becoming as financially intimate as you can with all of the family members. Of course, there's probably going to be one or two or a handful of family members who are critical, who are key players. So they'll probably kind of dictate, but don't forget about the other family members. Don't do that. So let's worry about the objectives and the constraints for various family members. We may have to create sub-portfolios for each family member, or we could lump, is that a good word? We could lump certain family members who have similar return objectives, similar willingness and ability to take risk. We can have those into one of those silos. Each subset has to be managed as a separate entity. That makes sense. Yeah, all those things are good. So this is what I said a little bit earlier. Do we want this direct indexing, which we've said enhances tax efficiency, or do we want portfolio customization? All that means is that, okay, you know, we're smart. We can figure this out. We don't need to passively index. We can go ahead and actively manage. But what that means then is that we're going to have to work a little bit harder. That is going to increase our tracking error. Look down at the, what's that, 1, 2, 3, 4. Let's see, attempting to minimize the tracking error. I'm going to go ahead and give you one of the answers to one of the text questions there. I think the first one, I can't remember what the first two were, but they were opposites of each other. And the third choice was, something about the tracking error. And that's the answer, because somewhere up in the case study, what the wealth manager is doing is in fact, I think they even use the word customizing or customization in the question stem. So it's so important for you to read the case or the vignette and pay attention to every word. In fact, I'm going to go ahead and give you advice. I've said this before, that I think it's worth it. I think it's worth it to go ahead when you get to the case, is go ahead and look at the questions. A lot of people like to do that. Go ahead and look at the question. Don't look at the answer choices. Just look at the questions, and then go up and read the case and read it twice. Because then if you read it twice, you'll get things like customization. You'll get things like rebalancing. You'll get things like a change, etc., etc. Yeah, look at the bottom there. Portfolio customization prioritizes all the investor goals. And so think about it. If you have a family and you have these little silos, and then you're going to say, well, let's just go ahead and invest in a fixed income and an equity index, or maybe 2 or 3 of each of those, depending on things like beta and interest rate risk and default risk and those kind of things. Is that strategy going to deliver the exact risk return objective that the client needs? I mean, maybe the answer is yes, but I'm guessing the answer is maybe not yes. Now, how about these concentrated positions from a tax perspective? So the risk of customization is that you're not going to be as diversified as you are inside of an index. So there you go, one, under diversification. Then you have to worry about those capital gains being accumulated over time, so that when we decide to sell that to achieve one of our, let's say, intermediate term goals, like investing in a vacation home or traveling all over the world, boom, we had this huge substantial capital gains liability that we have created. So what we can do then is we can complement it. We can have this fully diversified portfolio, and we can, kind of chop it up into pieces. Capital losses, capital gains can be offset. What this does, and this is the emphasis on the right hand, look at the bottom right there. This is an emphasis on that long-term goal. Remember, even if we have short, intermediate, and long-term goals, we still have the overriding aggregate portfolio goal. And this complementary portfolio might be able to help us achieve that. Yeah, effective tax rate across borders. This is not addressed in any of those questions at the end of the learning module. So what are some good exam questions here? So determine the effective tax rate. So we're going to have to figure out what those tax rates are, and then take an average or a weighted average of them across jurisdictions. Maybe a weighted average income tax rate, weighted average capital gains tax rate, weighted average wealth tax rate if we have it there. A major responsibility, determine that effective tax rate. Tax rules that could be unprofitable. Tax laws are constantly changing. Remember, I'm going to repeat myself, we don't have to be experts, just know somebody who is. All right, let's try to finish up this taxable stuff. Let's go back to Harry Markowitz, what we had, 10, 12, 15 slides ago. What the Institute does here in this section is switch up notation just a little bit. I'm not quite sure why it does this. Maybe this will appear in an errata sometime soon. But we're doing the same thing. We're going to try to maximize utility. Now notice that in that previous iteration, we were maximizing by changing the weights in each of the asset classes. Here, we're trying to maximize the investor's utility, okay? That's the U there. Remember, utility, that's just satisfaction. What is satisfaction here? It's in 2 dimensions. We have expected return and we have risk. So the R is the expected return on the portfolio. The sigma squared is still the standard deviation. And for the life of me, I have no idea why the Institute would switch from gamma, which we used before, to lambda, which is used here. I don't know what the Institute would give you on the exam, but if it's gamma in this Markowitz stuff, if it's lambda in this Markowitz stuff, it still reflects that investor's coefficient of risk aversion, or however you want to say it. So there it is, lambda divided by 2. Now all we're doing to go from the blue to the red is we're just including taxes. Remember, we're trying to do tax efficient strategy. So all we're going to do is take the R and multiply it by 1 minus the tax rate. And then we're going to take the variance and multiply it by 1 minus the tax rate squared. Gosh, whatever you do, don't forget to square it when you're doing the standard deviation. Now, you should be asking yourself the question, okay, let me go back here. After tax, Jim, you just spent some time talking about, the regular old tax rate and then the capital gains tax rate and the ordinary and the qualified dividend tax rate. What is that tax thing here? So here, this is kind of just a general idea, but notice in the black there, we can go ahead and subtract out a capital gains tax. So think about that after-tax return, after-tax standard deviation as income tax, and then we subtract out the capital gains tax as well. So we're modifying this to make it more complete. Now, one of the big challenges for wealth managers, I'm sure you know this. My father was a great example of this when he was working, and then when he was retired, and then right before he died, is that you have this accumulation stage, and that accumulation stage ought to begin. It ought to begin the day you're born. You ought to pop out in your birthday suit and say something to your mom and dad, and it's like, hey, somebody take some money and go put it into a Roth IRA or some kind of an IRA. Do that for me today, even though I don't really know what I'm talking about. All right, so the accumulation, it usually starts right after you graduate from college and you get a job. So you accumulate and you accumulate and you accumulate, and then you retire and then you start spending. And so that word is decumulate. So think about this. It's not really exactly like, compounding and then discounting, but that's kind of a math equivalent of this. And so the idea here is that we have enough accumulation to decumulate all the way until we die. My father was petrified that he was going to outlive his wealth. And my sister and I would always say to him, we were like, you know what, dude, you can move in with one of us. We'll flip a coin, and the loser, you can move into the loser's house. So as we said, Dad, we'll take care of you. Don't really worry about it. All right, so let's look at the accumulation phase. What do we need to worry about? Future spending habits, returns and correlations. And then we need to create those portfolios that will accommodate those spending plans. That should make perfect sense. So to do this, we can compute a funding ratio. By the way, there's a funding ratio question at the end. I think it's the last one, the last case study. And let me show you this real quickly here. Although I'm going to show you, where the heck is that? Oh, here we go. I'm going to show you that you can compute the funding ratio a number of ways. Look at that second equal sign there. You can take the difference between the left-hand side and the right-hand side of the balance sheet and the returns. But the question at the end of this learning module is just take the assets, divide by the liabilities, and that's the funding ratio. Now, I think the cool part of this, and let's look at the example here. So there are our total assets. So that's all that stuff, including art and jewelry. So what is that? $5.5 million. And then here are liabilities. So notice we have regular old, kind of current liabilities, 50, 90, and 150. So that adds up to what? 290. Don't do this. Don't take the 5.5 divided by the 290. This is what I was saying just a few moments ago about you might have to compute present value. You probably won't have to compute it, but you'll have to understand it. So make sure that you include the present value of your living expenses in retirement, present value of the healthcare expenses in retirement. Who knows what those things are going to be, right? And then how much do you want to leave to your children or to anybody out there? There are tremendously well-known cases of wealthy individual people having, some of them have children, but leave all their wealth to their cat or their dog. I love telling my students that story. What do you do if you have a client who wants to leave, say $500 million to the cat? Well, you say that's really great. What does the cat need in retirement? The cat needs. How about if we buy a golden bed for the cat? That would be awesome, right? A nice thing. And there's a kitty litter over there. How much does the cat really need? And then why don't we donate some to the SPCA? And why don't we donate to these people over here who love cats? And then what? So you got to do all this kind of stuff. But don't be upset if you see, a bequest to a cat. If I were making up the exam, see, I have a sense of humor. I don't think this institute has a sense of humor on the exam. That's what I would do. But my point was, make sure you include the present value. So when we do the calculation here, so what was that first one? Yeah, 5.5. What's the second one? What's that? Almost 5.4. And subtract out the 1, so you get about 2% of a funding ratio. Oh, so this just means that, hey, we're okay, right? So that if we do all this stuff according to today's assumptions, then we ought to have enough capital to live. Couple must ensure that their funding ratio is positive. All right, so that's a good question. Now here's another follow-up question that's even better, is that, all right, suppose that we have a client a couple that has a funding ratio of 0.45. It's still positive, right? But we're concerned about it because we could have things like stock market crash, we could have things like COVID, we could have things like earthquakes, right? We could have all those kinds of things. So what can we do? Well, there you go. We can increase savings, that's obvious. We can reduce spending. That's tough for anybody, especially the federal government. We could continue working. That may or may not be a choice. We could get different jobs or new jobs. I have a great job being a college professor. Who knows when I'm going to retire? But I have lots of my high school friends who are retiring, and every one of them, except for one, has said and is doing something else. They're doing some consulting or some kind of a job. One of them works at Lowe's as a welcome to Lowe's. How can I direct you? Which is all super fun stuff. Here's some formulas here. You guys have to figure out which formulas you're going to memorize or not. But I'm guessing that you could, just based on all the stuff that we've done, level 1, level 2, level 3, you could probably figure this out based on being given an asset, liabilities, and the rest on the balance sheet. Yeah, savings for retirement. Individuals should start saving early. Yeah, that makes perfect sense. I don't really need to tell you about that. Rule 72. So what does that say? That if our interest rate is 10%, that's about 7 years, right? 7.2 years to double your money. Useful to understand the compound. Yeah. Power of compounding. I don't know what any of this stuff here. Did you even need to learn this back in level 1? So these are obvious notions. I'm not quite sure what kind of questions that the Institute could ask that you wouldn't be able to answer. But here's where it gets just a little bit more interesting. This brings in the specter of behavioral finance. So what are challenges? I mentioned this earlier, unexpected changes in health. This is super important. We don't know what healthcare costs are going to be next year, let alone 5 or 10 or 20 years from now. During retirement, lack of a purpose to one's life. My father was lucky in that he didn't suffer from this because he had his garden and he had his grandchildren, and he still went back and volunteered at his place of business. But lots of people don't have those kinds of opportunities. So look for a client who has, some person in the family who might have, a sense of loss of, some purpose in life, less interaction with colleagues and friends. That's why it's so important to make sure that you remain in contact. I was lucky. I had a great high school class, and I get together with these dudes every other month. I keep in contact with all the girls in my class through texting. I try to do all that, and I'm not even retired. I give this advice to my college students. I say to them, hey, when you see, these are to the dudes, I say, hey, when you see a girl that you graduated, you go up to her. When you say hello to her, you give her a hug. And you say, man, I'm so happy to see you. And when you see one of your high school friends, your dudes, you shake hands and say, I'm so happy to see you. Whether or not you liked each other in high school, because, high school's a tough time. Who likes anybody when they're in high school? But when you get to be my age, you like almost everybody out there. So I'm giving you these personal examples here so that you're prepared, to read a sentence or two in there. Suppose the case says, oh, Jim, he's so sad he doesn't have any friends. All right, this is a challenge in retirement. How can we overcome this? What's it called? Well, we can call it decumulation. We can call it whatever we want, psychological issue. All right, so decumulation, right? Lifespan's extremely variable, right? My wife and I are recently on a kick, which one of us is going to die sooner? It's not morbid at all. It's really funny. But it's not possible to hedge uncertainty. There's a couple of different things that we can do. We'll do that in just a second here. Yeah, this can lead to individuals oversaving during their working years and underspending in retirement. So this thing here, this last diamond point, is a great exam question where it's our responsibility to educate our client. If we have a client that's oversaving, we can say, look, here's the math. You're oversaving. You don't need to take out another $100 a week or whatever it might be. And you don't need to worry about saving because this is going to be your future value. And then, of course, we can assign probabilities. We can say, you have a 99% chance of having this amount of money on the day you retire. And then the underspending in retirement is very similar. My father went through this. He didn't want to spend any money. You may have heard stories about my dad in the past. All right, the next question then becomes, how do we handle the problem of decumulation? So what we can do is we can decide on which assets in the portfolio are going to earn a positive real return. Now, what that probably means then is we're going to go to those securities that have some kind of protection against inflation. So I think that's the really good question, the really good question and answer for that part one. The other issue then is we can go ahead and say, you know what, let somebody else take care of it. We can go to an insurance company and buy an annuity. Yeah, simple decumulation rule. Yeah, should not be. Yeah, I'm okay with these rules down there, but I'm guessing that the Institute is not going to ask you about, 20% and a real expected return. I'm guessing that the focus would probably be on identifying or at least confirming what a safe withdrawal rate might be. And in order to do that, you'd have to be able to predict the future and compute present values and future values. Here's this annuitization. You can just pay an insurance company upfront lump sum payment in exchange for periodic payments. Disadvantages, I've heard many people say this. I've never bought an annuity, but I keep hearing that they have tremendously high fees. And then there's some kind of risk of bankruptcy because remember, if I'm 62 and I live till I'm 100, what's the chance of that insurance company not being around when I'm 100? Or when I'm 90 or when I'm 80? I think these are some really good exam questions here. Innovations in retirement planning. So we know all about things like IRAs, but there are other vehicles out there. These are relatively new, although some of them go back a long time. What we need to do is make sure that we cover the gamut of responsibility for planning for our clients' retirement. A couple of relatively innovative kinds of securities that help with the problem of accumulation and decumulation and worrying about outliving your income are listed here today. How about this modern tontines? These go back to 17th century, maybe, 14th century, maybe even back to the time of the Phoenicians. This is where a group of individuals put some money into a pool. Maybe they throw it into a financial institution, and the financial institution says, all right, and let's suppose there's 10 individuals that, we'll pay each of you, well, whatever some rate of return is, depending on how much each individual person deposits. And then those, 10 people, those 10 people, they get their income. And then when one dies, that person is out of this fund, and then the 9 survivors, they receive the payment, and then 8, and then 7, and then 5, and then 2, and then the last one receives all those payments. So if you're the last one to die, you're sad because all your friends are gone, but you're happy because you have income until you die. So you see how these tontines, kind of eliminate the possibility of outliving your wealth. Retirement security bonds. These are cool things. These are probably issued by the government. They probably have lots of liquidity, and what you do is you decide how much you want to live on. Suppose you're going to retire in 10 years and you want $50,000 a year in retirement. Well, all you have to do is buy however many bonds that you need, and what happens is that you won't receive any coupons until you retire. So if let's say you're 50 and you want to retire when you're 65, then you wouldn't receive any coupons for 15 years. Then you retire when you're 65, and then you start receiving those. It's like a deferred annuity. And so it looks like a bond, but it's not quite a bond, but it's maybe a deferred bond. But these things are low risk. What did I say earlier? Probably issued by a government, and there probably needs to be some kind of inflation protection in these. And then you can combine long-term care insurance. You can combine that with retirement income. You can combine it with some other things into a single risk project. All right, how about this LOS on evaluating the performance of the portfolio? So we're going to do this one of two ways. We're going to do performance measurement and performance attribution. So let me just give you a quick example. Suppose we have a client that has a minimum acceptable return or a return objective of 10%. And suppose the wealth manager then generates, let's say, 14% during the course of that year. Well, is that good news or bad news? Well, clearly it's good news, but what we need to do is say, hey, if I would have sent my money to that wealth manager over there, maybe that wealth manager would have earned 16 or 18%. So we need to have some kind of a benchmark out there, and that benchmark has to be adjusted for risk. I mean, maybe that other one who, what did I say, earned 16 or 18%. Well, maybe they had a higher standard deviation or a higher beta, which would explain the 16 versus the 14 versus the 10. And then the attribution analysis is a manner in which we can determine whether or not the performance was due to things like luck, or was it due to security selection or asset allocation. So ideally, we're going to combine comparing against the benchmark with performance attribution to determine the performance of the portfolio and thus the wealth manager. All right, a couple of easy equations that we've seen many, many times before. All we're going to do is call this the arithmetic active return. We're just going to take the return on the portfolio and subtract the return on the benchmark. That was the, what did I have? What was that? The 14 minus the 10 in my previous example. We can call it an excess return if we take that same return on the portfolio, and instead of subtracting it from the benchmark, we subtract it from the risk-free rate of interest. We'll call that an excess return. And then, we can do, let me go back here. We can do this, on an annual basis. We can do this on an annual basis. But if we're looking over multiple time periods, we're probably going to want to compute the log active return and the log excess return. These are super easy. If you get to the exam question and you're asked which one of these two, either the red and the purple or the red and the, dark blue. Pick the red and the dark blue if it's over multiple time periods, because then that explicitly measures the impact of compounding. And there we go, right there at the top. So let's look at a quick example. 12, 3, and 8% during 3 months from a portfolio. Risk-free is 3, benchmark return is 6. So did we outperform? So what we can do is just go ahead back to our very beginning of level 1, add 1 to the 12 and the 3 and the 8%, and then subtract the 1, and we get 24.53% over that 3-month period. The benchmark return was 19.1%, so there we go. Outperforms, but we can go ahead and confirm that with the impact of compounding. So if you take the natural log there of both, you get 21 and 17. Notice that those two returns are lower. That should make perfect sense then. Yeah, how else are we going to do this? Sharp ratio, the information ratio. I'm hoping that you remember this from the old days. There's our log Sharp and our log information ratio. We don't have to divide by standard deviation. We could divide by value at risk. We could divide by conditional value at risk. We could divide by expected shortfall. We could divide by semi-standard deviation. We could divide by almost anything else that we want to. Now, if we divide by beta, then we call that's the trainer ratio. And if we throw in this minimum acceptable return, we can call it the Sortino ratio. And then once again, we can do the log as well. A couple of things down at the bottom. These don't have to be monthly returns, but a lot of times they are. When I do this for my students in my investments class, we always do monthly returns. So you can annualize those monthly returns by raising it to the add 1, raise it to the 12 minus 1. That gives you a conversion to an annual. But if you're doing the standard deviation, then you need to multiply them by the square root of 12, because we know that standard deviation moves through time at the square root. Now, the Institute calls this the accounting-based attribution. I never really heard it called that, but I'm okay with that name. We're going to say the following here. We have two decisions to make. We have the asset allocation decision to make, and let's just use fixed income and equity securities, and let's just start out with 50-50, right? So if we have this strategic asset allocation of 50% debt and 50% equity, what we can do as the wealth manager is we can deviate from those strategic allocations. We could do 40% debt, 60% equity. We could do 90% equity and 10% debt. So the asset allocation effect is going to evaluate the impact of our deviations from that original strategic asset allocation, or how they deviate from the benchmark. I'll show you that here in just a second. Then what we can do is say, all right, well, let's suppose we had 10 bonds in our bond portfolio and 20 stocks in our stock portfolio. Well, we had to pick those 10 bonds and those 10 stocks. What if we pick something else? So the security selection. So we have two important decisions here to identify the allocation to the different sectors, the different asset classes, and which assets go inside of those things. And then there's a compounding effect. We call that the interaction effect. Now, you can also do this with a factor-based attribution. We did a lot of this back in level 2. But the Institute doesn't spend too much time on this factors-based attribution, whether that factor could be inflation, maybe the factor could be growth rates in dividends, maybe the factor is exchange rates, maybe the factor is, well, you pick a factor. And so what you can do is you can identify that factor inside of the portfolio and say, oh my gosh, we want to be exposed to inflation. So when inflation fell, all of these stocks went up, plus we had the allocation to that class as well. We've done this before, right? How do we select a manager? What we want to do is we want to select the best manager out there. How do we do this? Some test of reasonableness. This is what we go through when I take my students to Morningstar. We always go to the mutual fund managers, and many of them hold the CFA designation. And so my students will always say, hey, look, Jim, you could be doing this. And I just laugh. Well thought out and defensible investment products process. Long-term value added. I'll say one quick thing down at the bottom. I say this regularly. Remember, the Institute, they like you to evaluate, they like you to monitor, they like you to adjust, so make sure you do that. So here's our quick example. So we've got A and B, 5 million and 10 million. They have 50% of their individual investments in the S&P 500, 50% to the bonds. All right, so during the improving global economy, the advisors have them allocate 70% in stocks, 30% in bonds, all right, which would be managed actively. All right, so this is what happens a year later. So the S&P 500 returned 9, the bond returned 1, actively managed stocks returned 7, actively managed bonds returned 2. Oh, all right, so there's a little bit of a difference in there. You see, we have this choice. So we went from 50 and 50 to 70 and 30. And then the performance, we got the stocks 7, but the index was 9. We got the bonds 2, but the index was 1. So let's try to figure this out. All right. So we need to first ask ourselves the question, did we outperform the benchmark? So very simply, we do 50% of 9, 50% of 1, right? So that gives us a 5% benchmark return. But our actively managed portfolios, 70% and 30% of the 7 and 2, so that's 5.5%, right? So this recommended strategy outperformed by 0.5%. Makes perfect sense. So what we're going to do is we're going to attribute that 0.5% to those decisions. So we need to do a little bit more math here. All right, so in that prior year, 70 times 9 plus 30 times 1, that gives us the 6.5, and the 50 times 7 and the 50 times 2. So you know what we did in that, in those first calculations, we took the 70 and the 30, let me go back here. We took the 70 and the 30 and we multiplied it by the 9 and the 1. We took the new weights and we multiplied it by the index, right? 70, 30, 9, 1. Then we did just the opposite. We took the old weights, the 50 and 50, and we multiplied them by the active returns, the 7% and the 2%. So there you go. We got the 6.5 and the 4.5%. So let's figure out what this allocation effect is and the selection effect is. And this is super easy. So we take that, for the allocation effect, we take the 6.5% minus the 5, right? Where do we get that 5? There it is, the benchmark minus the 5. That gets us 1.6. So in our allocation, we gained 1.6%. That was a good decision to go from 50-50 to 70-30. But the selection effect here, we got 4.5% minus 5. That's just 0.5% because even though the bond went from 1 to 2, the stock went from 9 to 7, so that was no good. That's bad news. So we lost 0.5% in the selection effect. And then we need to do the combined thing here, the interaction effect, and that's a minus 0.6. So if you do the math here, what's 1.6? You ready? 1.6 minus 0.5, that gets us down to 1.1. Minus 0.6, that gets us down to minus 0.5, right? And there we go. There's our recommendation of 5.5 versus 5. We outperformed by 0.5%. So 1.6 minus 0.5 minus 0.6 gives us that 0.5. So we attributed it, right? We made good allocation decisions. We made a poor selection decision. And the poor selection decision dominated the good allocation. Whoops, I went the wrong way. Dominated the good allocation decision. So there we go. And that takes us through our learning outcome statements. So what I want you to do is go look at those 4 cases. You probably should allocate, I'm going to say, a good 30 minutes on these things. Although I've given you the answer for a bunch of them. You'll see in some of the comments that I have made. So, hey, thanks for watching and good luck studying.